Welcome to ForexTV.com. Today's Thursday, March 5th. I'm Tim Kelly with your New York Forex Market Buzz. Dollar is stronger against most majors, but giving ground to the yen halfway through the U.S. session. And now for a look at the latest headlines from the CEP news desk. Bank of England cuts rates to 50 basis points and announces quantitative easing. As widely expected, the Bank of England cuts its benchmark interest rate by 50 basis points to a new record low of 0.5% and pledged to begin purchasing gilts by using its balance sheet. The BOE pledged to purchase £75 billion at its asset purchase facility by using the central bank's balance sheet rather than the original plan to finance the APF by using short-term debt from the Treasury. The ECB also cuts benchmark rate to 1.5 percentage points as expected. The European Central Bank's Governing Council reduced its main refinancing rate by 50 basis points, bringing the headline rate down to a record low of 1.5%. Speaking after the rate decision, ECB President Jean-Claude Trichet said that further evidence has emerged pointing to ongoing weakness in both Eurozone and global economic demand, while inflation is expected to remain well below the European Central Bank's target level through to 2010. Elsewhere, U.S. initial jobless claims eased back from the highs. First-time claims for unemployment benefits in the U.S. fell to 639,000 in the week ending February 28th, following an upward revision to the previous week's claim to 670,000. That according to the Department of Labor in the U.S. Claims were forecast to come in at 650,000. Meanwhile, continuing claims fell to 5.1 million in the week ending February 21st, below the consensus forecast for a rise to 5,155,000. The prior week's level of 5.112 was a revise up to 5,120,000. Final U.S. labor costs revised up, productivity revised sharply down. Final U.S. labor productivity fell an annualized 0.4% in the fourth quarter, much less than the 3.2% increase originally reported, according to the Department of Labor. Economists were expecting a downward revision to a plus 1%. Final unit labor costs were revised to an annualized 5.7% increase, up from the 1.8% rise originally reported. Economists were expecting an upward revision to 3.8%. Meanwhile, U.S. factory orders dropped less than expected. Factory orders in the U.S. dropped further for the sixth straight month in January, but much less than economists expected. Orders fell by 1.9% against expectations for a 3.5% drop, and following the downwardly revised 4.9% decline in December, that according to the Census Bureau. An MBA, the Mortgage Bankers Association, says 1 in 8 U.S. mortgages delinquent in the fourth quarter. Mortgage delinquencies for U.S. homes in the fourth quarter rose to a new record high of 7.88%, meaning 1 out of 8 homeowners is behind on one or more mortgage payments, that according to the MBA. The result is above the 6.99% rate reported in the third quarter, previous record high. Today we're joined by Vassili Serebriakov, currency strategist at Wells Fargo. Vassili, thanks for joining us today.
Thank you.
Vassili, we have a lot of data out today, and we had some comments by the Chinese premier last night where I think some traders were a little disappointed that there was no mention of the stimulus details that were widely rumored. What do you make of today's currency action?
Yeah, I think the reference to the disappointment with the comments from China this morning is correct. There was some hope in the markets after yesterday's signals that the Chinese fiscal stimulus is going to be increased substantially. There was some optimism and perhaps higher risk appetite in the markets yesterday. But after today's lack of news or lack of specifics from China, I think the risk appetite was on the defensive again, and we're seeing equity markets around the world lower today.
Yeah, there was a pretty sharp sell-off after yesterday's bounce. I think that it's quite clear here halfway through the session, a couple of hours left now, that basically had a bit of a bear market rally yesterday. What do you think, with most of the data out this week, what drives us for the rest of today's session and the overnight and into tomorrow?
I think, the U.S. payrolls report is still a key release tomorrow, and although today's jobless claims were not as weak as expected, perhaps, most of the signs, including the ADP employment survey and the employment component of the ISM survey, signal that the payrolls report is likely to be very weak. In fact, it's likely to be the weakest even in the latest series of very disappointing reports. Now, with regards to the impact on the dollar, it could be much more ambiguous in the sense that the dollar is still benefiting from weak equity markets. So if the numbers that trigger further equity market declines, this would actually have a mixed or somewhat a positive impact on the dollar.
Well, do we at this point, is it just baked into the cake that the employment figure is going to be a dire reading?
Yeah, I think there are very pessimistic expectations already, which again might suggest that if the number is not as bad as feared, this could give a slight boost to risk appetite. But I think in the global scheme of things, in the overall picture, this would not change much. I think an important level in the equity markets was 740 on the S&P 500 index, which we broke last Friday. I think that signaled that we could see another lag down on the equity markets in general, and I think that's going to continue weighing on risk appetite going forward.
Well, from that point, let's focus in on dollar yen. Dollar's giving up ground to yen. Is this profit taking, you think, at this point?
Yeah, the yen is an interesting story in the sense that it has decoupled in recent weeks from the equity markets. Of course, the yen has been the beneficiary of much of this risk aversion in recent months. What happened in Japan is really the deterioration in the external balances, not just in the trade balance, but also in the some of the investment outflows that we've seen, and that's really left the U.S. dollar alone in its safe haven status pretty much in recent weeks. I think the move in the yen was quite dramatic in the past days and weeks. So what we're seeing now in terms of yen strength is likely to be a correction of that move.
Speaking of safe haven status, gold gained today after giving up some ground. Again, probably taking a rest there, but after some dramatic gains and reaching that psychological 1,000 mark, seems to be on the bull track again. Do you see that as a harbinger of the risk appetite out there?
Well, it's almost like gold benefits under just about any scenario these days, it appears, and it's certainly one of the instruments that appear to be in favor with the investors. We would be cautious about further gains at this point as far as gold is concerned, but looking wider and looking at the currency market specifics, for sure it does suggest that, for example, commodity currencies or emerging market currencies continue to be under some pressure in the months and in the months ahead.
Well, when we look at the CRB index, there's some movement there. The savior there was supposed to be this economic stimulus package. Those exporting commodities to China were thought to be the beneficiaries of that. If that does materialize and we get some details, does that change your view?
No, I think the lesson of the really price action this year and the second half of last year is that there's simply no simple solution. There's no silver bullet. There's no one decision or policy action by central banks or governments around the world that is just suddenly going to turn around the global economy. So in other words, I think the markets will really have to go through this and wait for a global cyclical turnaround, and judging by the latest economic data, we certainly don't think that point is here yet. We may be some way away from this cyclical turnaround at this moment.
Vassili, in the time we have left, is there anything specific that you're focusing on in terms of currency pairs or market sectors?
Yes, I think today, focusing a little bit more on the rate decisions, it's interesting the contrasting stance between the Bank of England, which not only cut rates to near zero level, but very explicitly embraced non-conventional easing, and in fact seems to be set on expanding the money supply, whereas the European Central Bank is still much more gradual mode and perhaps not fully set on the unconventional policy path. We think in the medium term this is going to be a negative for the euro, and we actually do think that the early and aggressive price action in the U.S. or in the U.K. Is going to benefit those currencies down the road. So we would focus on perhaps shorting the euro against the pound and the U.S. dollar at this point.
Vassili, just for our viewers, this idea of quantitative easing is where the governments go and purchase assets. In the case of the UK, they've targeted gilts to free up money supply or to essentially flood the market with money and thereby accelerating the what they call the velocity of money. We did that in the U.S. Obviously, the stimulus package has some elements of that. How effective, I just want to follow up on that. How effective do you think that can be at this point? And also, the ECB does not necessarily have the mandate to do that at this point, do they?
Well, let's put it this way. It's very clear that the central banks are increasingly running out of conventional policy measures, which are, of course, the interest rates. Interest rates are either near zero at a lot of G10 countries or very close to that level. Yet, we have not seen any substantial impact on the economic growth from these measures. So it's perhaps not entirely surprising that G10 central banks are increasingly moving to these non-conventional measures. Now, those measures can take different forms across different countries. Looking at sort of narrow money supply measures such as the monetary base, we see that the U.S. is still at the forefront. The monetary base is growing at the fastest rate in the U.S. compared, for example, to the Eurozone, UK, and Japan. But we think in the medium term, there's just no escape from for policymakers from moving more towards those non-conventional measures, and the ECB as well. I think they may take some time to find the exact measures that they want to implement, but they'll move in that direction nevertheless.
Well, Vassili, thanks for your insight. So, the bottom line here is, continuing the dollar strength trend. Is that our takeaway here today?
Yeah, that remains very much our view, both from the point of view of the subdued risk appetites and the equity market weakness that we think is going to persist, and the fact that the Fed was early and aggressive in its easing campaign, including both interest rate cuts and non-conventional measures, and I think that's going to be growth supportive down the road. So overall, a strong dollar view very much prevails.
Okay, we're going to leave it there. Vassili, thanks for joining us today.
Thank you.
This has been your New York Forex Market Buzz with Vassili Serebriakov of Wells Fargo. I'm Tim Kelly. Join us later this afternoon for PM Exchange right here on ForexTV.com.